From the morning reading, spiders, diamonds, and Qs hit new all-time closing highs. The spiders and Qs have a horizontal breakout, and the VIX being lower confirms the SPX high. Breadth strengthened compared to the prior session as decliners led 1584 to 1431 on the New York Stock Exchange and led 1508 to 1251 on the NASDAQ. That's a kind of a peculiar situation, and one of the other morning reading authors will comment on that further. The December reading from the conference board showed the consumer confidence vaulted up to a level not seen since August of 2001, with all the gain coming from future expectations component. This is a clearly positive indication for the economy over the near term, but it could turn into a negative over the longer term if consumer expectations get ahead of economic and political realities. Breadth was not good on Friday. Despite the new all-time high in the S&P 500, there were more declining securities than advancing ones on the New York Stock Exchange. The amount of volume flowing into those securities was the fifth worst ever on a day the S&P hit a new all-time high. And the percentage of issues reaching a 52-week high wasn't far behind, also lagging badly. The last time breadth was this bad at an all-time high in the S&P was the bull market peak of March 24th of 2000. It's not just about bonds. Small cap stocks were also weak, and that also has an impact on breadth figures. Even within the S&P 500 itself, there was something of a divergence. The S&P index that almost everyone follows reached a new high, but the equal-weighted S&P 500 index did not. That has also usually led to some weakness over the shorter term. The new high came on a day the jobs report missed expectations. The non-farm payroll report came in less than economics estimates, yet the S&P powered to a new high. It seems like good news, but the prior times it happened, stocks usually pull back over the ensuing weeks. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:11 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 9th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, the market was a bit mixed. All four of the U.S. broad-based indices were kind of going in different directions, with the S&P and the Dow down just below scratch, the NASDAQ just above scratch, and the Russell, the weakest of the four, at down about 1/3%. Crude oil is down big, down about 2%. Euro is down just below scratch. Bonds up about 1/3, and gold up about 0.4. In overseas action, looks like Japan was not open for the session. China and Hong Kong are open in Asia, though, with China up about 0.5%, Hong Kong up about 0.25%. In European action, Germany's down about 0.4%, but the United Kingdom is up just above scratch. In macroeconomic reports of note for today in the United States, we have none. No orange or red flag reports. And looking forward to tomorrow, we have the JOLTS job opening. So pretty quiet beginning of the week for the U.S. macroeconomic front. In terms of current volatility conditions, we have short-term VIX at a 9.19, so exceptionally low. Skew is benign, below the first caution threshold. IV percentiles are also exceptionally low, with 2 of the 4 in single digits. The S&P at a 9, the Russell at an 8, the NASDAQ at a 10, and the Dow at a 12. We did have on a close-to-close basis one index with a larger than 1 standard deviation move, and that was the NASDAQ. The others less than that. Okay, let's go ahead and go to the charts. And on our S&P futures, while we did have that new high on the S&P futures chart come in on Friday's session, you see it closed just above the area of resistance. So not really a strong confirmed breakout of this, multiple week area of resistance yet. So we'll wait to see if we can actually clear the area. Right now, I remain, unconvinced when we have such a modest breakout. Also, especially when you take a look at the other indices, you see the Dow did not break out, though it's up near its area of resistance. Very similar pattern to the S&P futures. But on the Russell, of course, we were going the other direction. While it continues to stay in this sideways rectangle, and you notice similar highs, similar lows, with the lows being supported not just by the bottom of the rectangle, but also by this ascending channel that it had broken out of some time ago and is still in place. So we have a combination of that channel and these moving average lines that would seem to be supporting the Russell up to this point. So bottom line is all this action here, and you look at last week, we had one day that was up 2 standard deviation move, then followed by a down 1 standard deviation move. None of that mattered. That was all within the box. It's just noise within the box until we get a breakout either above all this action or below all this action. It's just noise. And then the NASDAQ was the one that made the confirmed breakout. So while the S&P, had a new closing high, but it was right at the area of resistance, you had a different situation in the NASDAQ where it clearly stepped out. So you had this recent action where you kind of set up this flag pattern, broke out, confirmed nicely, hit the first target and powered through that. So the NASDAQ seems to be building on some recent strength. And let's take a look at a few other markets. Crude oil, sideways consolidation pattern. And then, of course, gold. Gold has been in something of a retracement, but I'd be very hesitant to get long in gold. I'd be looking at this much like this pattern here, where you have a bit of a retracement just to then fall down for the next leg. The same thing over in bonds. And of course, all this related to what's happening in the dollar. Dollar had a bit of a pullback, but is likely to set up to come out and take out these highs at some point into the future. And then let's see, what else do we have? We got bonds, gold, crude. Let's go ahead and take care of the VIX. And the VIX is down here in this very low area. It's actually been below 12. We think of 12 to 15 as the normal bull market kind of chatter area, and it's actually been even lower than that of lately. So volatility actually is in the area where we start to watch for a potential expansion of volatility, because it's been so low that the only way to go really is to go up. And while volatility can go up, it can certainly take some time to do that. So just be aware of that. This is just where we start to watch for an expansion in volatility, not predict that it's imminent. And let's go ahead and go over to the daily report. Not a lot of changes, but some over the weekend. Mostly in the top section here, pretty much the same. Intermediate term phase opinion, market phase 3. This is your bull flag and bullish continuation patterns. And the 3 market timing signals, all mechanical in nature. The first one comes to us from IBD, confirmed uptrend bullish. GMI index, also bullish at a 5 out of 6. That buy signal been in place since 11:10. Stock charts decision point scoreboard had one improvement in a signal on the intermediate term. We now have all 8 signals signaling bullish in the intermediate term, which is our primary trading and investing time frame. Short term, though, a bit more mixed, with 3 of the 8 signals, or nearly half, are still bearish. So mixed signals there, and then also mixed signals on the long term. Overall consensus of all this is that we have a bullish signal, but recognizing that with these mixed signals coming to us from Stock Charts Decision Point Scoreboard, that we're likely to see charts just like what we have been seeing, as a matter of fact, with this kind of largely sideways chop with pressing to new highs periodically, but certainly not an easy bullish trending higher highs, higher lows kind of market. Lots of sideways consolidation in between legs higher. And that's pretty much what you expect there. Position sizing opinions on both models at 100%. On the intermediate term market posture, exceptionally strong bull coming out of S&P, Dow, and the those two. The NASDAQ just below that threshold. If it turns in up over 80, that will also join the exceptionally strong bull camp. This is all supported by an exceptionally strong bullish sentiment line. So that longer term line is also supportive of a bullish market. Now we'll say there is an area of weakness, and that is the Russell. It has dropped into a weak bear. The strength of the trend still continues to be very high. Nothing of concern there. Hedge warning status 0+ on our 0 to 3 scale. Normal with some elevated conditions. So relatively bullish there, relatively low risk environment. Option income strategies, the VIX is actually at this point just below the acceptable range to initiate new positions for novice traders. We've left this definition as acceptable and just going to comment on the fact that we're just below. We've been toggling back and forth between below 12 and just above 12. So just be aware that the current situation is that premiums are relatively low compared to the amount of risk that you're taking on. So you got to be prepared for that situation. If you're a novice trader, it might be a situation that's beyond what you want to be setting up new positions. Cover call strategies and put selling both are acceptable to initiate new positions for novice traders is the opinion. Some conservatism still at these levels. We continue to see this kind of largely sideways action and some expectation that we could get, something of a real retracement. It's one of those things where we have several suggestions from the indicators that we could get that retracement, and yet at the same time, other indicators are saying that retracement would likely be relatively mild. In terms of specific areas of warning, most of this in the volatility areas pointing to this very low volatility, and then the opposite coming out of that low volatility and expectation of expansion of volatility. So you see this volatility ratio warning. It's into the firing position. Your VIX is below a 12. You're in a daily squeeze. All different ways of looking at volatility basically tell you to look for and watch for that potential for increasing volatility. The distribution day count that's been persistently high on the NASDAQ has been eroding down. It's down to a 6 now. If it drops below a 5, it will come off of warning status. In terms of the trend-based area, everything looks fine here. In terms of the inner market risk aversion indicators, all 5 are still risk off, and that is one of the primary areas of warning that still persists. Overall fear and greed index, it's at a 70, so a bit high, but not extreme. In terms of sector specific, you see mostly risk on with the top performers of Friday: information tech, industrials, consumer, financials, all risk on sectors, and then that's then followed by utilities. Also, other kind of defensive sectors were largely doing more poorly. Telecom, consumer staples, real estate, all basically at scratch. Now remember, telecom is basically made up of only 5 companies, and 2 of those are essentially some 90% of the volume or capital value, Verizon and AT&T. So this is really representative of what was going on in just 2 companies down there. In terms of market posture across different time frames, Probably the thing to note is those that are weaker. Retail, industrials, energy, and transportation are the weaker ones, especially the short to intermediate term time frames at this point. In terms of percent change, mostly green across all the different time frames, and nobody's really standing out as consistently bearish. And most of these numbers that are bearish are relatively modest, so not particularly anything here to get excited about in terms of area of weakness. You might focus on those that are most consistently and more strongly bullish. In terms of the relative rotation graph, the blowaway winner continues to be regional banking. If you were to actually put this to scale, you'd have to drag all this down, and KRE would be way up here in the stratosphere. So it has just been running away with its improving strength of late. Now others, IYT, transportation, home construction, telecommunications are seeing improvement, while at the same time some that are falling back are real estate, utilities, FDN. This one was doing very, very well for a very long time, and it started to fall a bit out of favor. Let's kind of keep that in mind. Okay, that should be enough for today on all those areas. Let's go ahead and wrap this up. And let me just make a comment about this right here. If you want to subscribe to the YouTube channel, that will allow you to get notice when these are published. Once you get that notice, give it just a moment so that it is available to you in high def. A couple other things to be aware of, and the way you subscribe to that, by the way, is you can go to this hyperlink right here, and that will allow you to hit the red button here under subscribe, and that will subscribe you to the Falcon Global Market Preview YouTube channel. There's no cost to that. It just gives you notification. Now once you're subscribed and you get that notification, you want to make sure that you're watching in high def. So when you see these the gear to the access settings, just make sure that that's showing that HD on there, that you're seeing this in high def. That'll give you greater clarity on the charts and so forth. You can also use this button to see it in full screen, and then toggle back off of that as you like. And then the last thing I draw your attention to is you do have the capability within those gear settings to change the playback speed. And most people probably listen to these videos at about 1.5x. That turns a 20-minute video into about 13 minutes. And you could probably have full understanding of everything I'm saying. You can listen faster than I can speak, is the basic gist of it. So if you hear something that you're particularly interested in, you can always slow it back down or hit the pause or anything like that. So just be aware that those settings, those buttons, those tools are available to you. Okay. And I'll move through the rest of these slides. If you have a particular interest, just hit the pause button, get the details. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We should be back here next for tomorrow's market preview from Falcon Global. In the meantime, manage that risk profile and seek to go out there and learn something about your trade craft each and every session. Good trading.